Hello and welcome to BQ Prime. I'm Hiral Dadia. We have L&T Technology Services. That's a stock to focus on the back of Q3 numbers that have been reported. Joining us on the show is Amit Chadha, CEO and Managing Director at L&T Technology Services, joining in. Welcome to the show, Amit, and a pleasure to speak to you as always.
Ma'am, thank you, and a very happy new year to you.
Wish you the same as well. Amit, overall, do you think the quarter has met your internal expectations as well, taking into consideration the global perspective and the scenario that's running all around? Because clearly, if we see the numbers, there is a gain from the MF sale, sale which has been utilized for provisioning. Overall good growth that has come in. However, there have been some concerns in terms of the guidance cut and the cautious outlook.
Sure. So let me start by saying that this quarter we worked towards it, we planned towards it, and we've achieved two milestones. Number one, we've crossed 1,000 patents filing for the company, making it consistent now that for about 2 years we've been filing about 50 patents every quarter, 25 for our customers, 25 for ourselves. So I do believe that for a technology company, for an engineering company, that is a huge achievement, right? It's a mark. Second, our profits crossed the 300, so net profits crossed 300 crore mark, which again is a first for us. They were up 22% year on year. The EBIT margin was 18.7%, both again highest ever that we've been able to achieve. So from that standpoint, very pleased, thankful, proud. But having said that, I do believe that revenue came in a tad bit muted, and we knew it would be muted, but it was more muted than we expected because at the end of the quarter, towards the end of the quarter, we got some of our plant engineering customers coming in, pausing some projects and moving them actually to January because they were trying to balance their budgets. Those projects have since come back, started. So I do believe that even though we were saying overall annually we'll be at about 15% organic, Q4 should come back to growth that we used to have in Q1, Q2 levels, and then we'll continue to work and build towards it. We also were able to get 5-10 million wins, which again last quarter was a little lower, so this quarter it's back. TCV is similar to that we've got. In fact, a significant empanelment with Airbus that highlights and recognizes our digital engineering capabilities and aerospace domain knowledge. So overall, if you ask me, a fairly quick quarter. It's lower number of working days and done and dusted. We believe in moving on and looking upward and onward, and I do believe the Q4 looks good, as well as the year we'll end up at about 15%.
Right.
And profit margins, of course. And profit margins, of course, higher, more patents.
Right. So with all of this said and done, now with the acquisition, as you just mentioned about SVC, clearly you've reconfirmed your aspiration of the $1.5 billion run rate by FY25. However, is majority of this going to come in due to the SWC acquisition?
So number one, I want to confirm that the LTTS heritage business will continue to grow double digit as we move forward. Right? Margins, we've been able to get a playbook of getting to that 18 first. We stabilized now in that 18.5% range, stable, right? So we have a playbook. Now, having said that, I do believe that will continue. Now let's go to the SWC acquisition. The SWC acquisition, please look at it as a capability enhancement, as well as adding to white spaces that we did not have, rather than a revenue or a client-only acquisition, right? When we went for it, what we thought about was that given our 6 bets that we have got, EACV was on its way. We didn't need to acquire anything for that, except potentially maybe something good comes up in Europe that's reasonable. We'll look at it, right? Otherwise, we are okay. We looked at MedTech. We've got huge solutions. Maybe something comes in healthcare, we look at it, but otherwise we're fine, right? Digital manufacturing, we're doing well on our own. We don't need an acquisition in that space. Digital products, we were okay. We didn't need an acquisition in the space. However, when we looked at 5G and we looked at sustainability, these two areas for us were that we were constrained in a certain space. 5G, we work with 6 of top 10 global OEMs. infra OEMs. We work with 4 of 10 operators in North America and Europe, right? So when we go to them, they'd say, great, why don't you do this part of it? But network engineering, I think at scale, you're not there. You're not in the big boys club or the big girls club or whatever, right? So we turned around and said, we want to get something that will give us scale, that will give us qualifications to even appear for the large deal, which don't even come to us because we don't have the capability in the area. So Smart World brings that very important capability. They have actually envisaged networks. They have built data centers, NOCs, SOCs. They own a NOC and a SOC, which we don't possess. They've got a foundry, in Hyderabad for software development for applications and key widgets, which we don't have. So we thought it was an amazing thing to come together and address the space. On sustainability, I'll take a minute and then we'll go to the next question. Sorry, long-winded answer. So COP27 comes out with a real spend that will come out through governments. Today, we are not able to address it. So I do believe that the smart cities work that they've got, which is about a 30 million business, are $10 million of smart buildings that we've got coming together and addressing not just smart, but sustainable and smart spaces will provide avenues to the company. Finally, sorry.
Yeah, but why I'm going to interrupt over here is I understand all the growth aspects as to how, it adds to our vision, etc. However, on the back of the acquisition, we are still margin dilutive in terms of the acquisition. And that probably is indicating potential weakness in the growth story, specifically in terms of the risk and reward. Any comments that you would want to give on that front?
Yes, please. So number one, we now are at about that 18.5% EBIT range that now we've operated at, and we are comfortable in that area. And this business will continue to operate and potentially improve in this area because we can improve the offshoring lever. We can still work on the pyramid. So we'll continue to do that. One. Second, any acquisition that you do at this scale, right? You've got 2 choices. Either you get something where you're going to be able to improve the margins and therefore create more value for your shareholders, right? Or you buy something with high margins, but pay more for that acquisition. So you've got to think about it and look at, what you can do. We believe we have the leadership, we have the playbook that can turn around the margins of Smart World to the extent that the company the immediate margins in Q1 potentially will go down, right? As we have guided between 180 to 200 bips, but you will see recovery thereafter. And by H1 of FY26, we should be back at the same levels jointly. And at that point, we'll be 1.5 billion plus. So I think this is actually margin accretive. This is also good in terms of unlocking value that this will create for our shareholders.
Right. So overall, with all of this said and done, we're talking of $1.5 billion in revenue, by FY25. Operating margins recovery back to, say, 18% as well. Do you think there is a possibility, and mind you, I'm saying there is a possibility of it being a stretch because taking the macros that are severely deteriorating, nothing to do with, the company as a whole, but overall the global situation. Do you think there is a slight chance of a slip?
Look, I do want to say this, that, if people are expecting that there will be a recession like COVID created, I don't think so.
Right.
If I look at the macros and I look at the underlying consumer spend patterns, etc., I do believe that electrification of vehicles, right, automation of the workplace, because there is lesser number of workers in the workplace, as well as digitization so that people can get access and get new markets, as well as 5G, because that then becomes the backbone, right, for you to operate on, and medical technologies will continue to expand. There will be, and we have seen ourselves, right, in the last 18 months, there will be a shifting of profit pools and spend pools that will happen. A company that will survive this is somebody that is agile and that is in the marketplace and listening to the customer and the consumer. I do understand one needs to be internally focused, But I honestly believe you've got to be listening to your customer and your consumer. And the consumer and the customer, if you ask me, is something that what I make out from whatever client meetings I've had in the US and Europe, and I actually just came in this week. And from the first of the year, in fact, second, I was on a plane. And I've been traveling like crazy, meeting with our clients. Our sales leaders have been doing it. In fact, our CEO was in Europe recently. So everybody has been meeting people. And these meetings are not just goodwill gestures, but discussions on what to do about product development, enhancements, rollouts, etc. So I am cautiously optimistic about CY23 and CY24 and beyond.
Right. And overall, in terms of segments, I mean, transportation has been the highlight of the quarter as well, with the performance that we've seen, right?
Yes.
From there on, a decline that has come in on the plant and engineering, and we know this is due to higher furloughs at some of the top customers. Industrial, again, overall, a moderate growth, and telecom has continued to decline, whereas medical has also continued to see some bit of a decline coming in there. So from an industry perspective, how are you, and by when are you seeing a revival come in specifically in, segments which are either moderate right now or on a declining trend?
Sure. Thank you. Very fair question. Transportation continues to grow and will continue to do well as we move forward. Industrial products is one of our oldest verticals. There's a lot of emotion around industrial products in the company. And I believe that industrial products, with the 3 wins they've had, or the 10 million plus and the ramp up that has happened, I do believe you will see an ongoing growth trajectory for industrial. Plant was a one-off issue for a certain set of furloughs in December. In fact, I myself, with our CEO, traveled out to Baroda, met with our employees, etc. as well, and then our clients globally. And I do believe that it's a one-off furlough issue. Q4, you will see plant engineering come back. Medical, we haven't done well this year. I will acknowledge that. And that's been because of various macros and the conservativeness of the particular client set, etc. But I believe that you will start seeing from Q4, medical will grow because you had some sub $10 million wins in that area. Telecom high tech, I think will be a recovery in, I would put it at a Q1, Q2, FY24. Though Q4 of this year also you will see growth, but you will see bigger growth coming in sometime in FY24. I also believe that the Smart World acquisition that we have done will allow us to be able to accelerate the growth in that particular segment.
Right. And from an attrition and utilization perspective, how are you seeing the trend from here on? Because clearly, I think in the coming quarter as well, additions in terms of employee count is going to be higher versus what we've seen in the third quarter.
So one, happy to share, attrition went down by 1% for us, right. Almost 1% for us. I do see that trend to continue, and attrition will further come down next quarter as well. There is, we are running programs. In fact, we ran a program called Rendezvous 1.0, where we heard our employees out and then we acted on it. And now we've created Rendezvous 2.0, that after we achieved the Great Place to Work qualification, we then came in and said, what can we do differently for you? Feedback came in and we are working on it. The interesting part, we do go back and honestly share the feedback that they give us. So we're not scared to tell them as to what they told us, right? Because first of all, you got to be honest and direct in terms of what we heard. Because if I don't hear what they are trying to say, I don't listen, I can't fix it, right? So we've done that, and jointly there are very tall business leaders in our company, and I'm fortunate to have them working with us. We have worked together to try and work on it. So a lot of compliments there. Utilization we stopped giving out utilization numbers, but I can share with you that we've reached the 80% plus utilization range. We're satisfied. In fact, one of the things that worked in our favor in the last couple of quarters in improving our margins has been our utilization. Having said that, we believe we've reached the right levels, and we will be adding actually more than 500 net people in Q4. And then we are making plans to hire for Q1, Q2, Q3 of next year as well. So hiring continues, and I'm fairly comfortable in that space.
Right. Overall, from a revenue mix perspective, the growth in terms of on-site overall has been slightly softer than what we've seen in the previous quarters, right? We've always seen an upward trajectory. I think Q3 FY22 is where we were in that 14% range. We are back in that 14.7% range. So is this a seasonality factor that we're looking at, or is it something else?
On-site growth, see, in fact, we want to grow our offshore revenues. That gives us better profit margin. It's a lever. In fact,
Right.
we're today at about 57% offshore. We'd like to go to 60% offshore if we can. So we'll continue to do that and work on it. And see, this go plus minus 2% keeps on happening because you starting new projects, you're putting more people on site, etc., etc. So fairly comfortable with that at this stage, but it's a lever for us. You said it very right. It's a lever for us to be able to expand in the future on margins.
Right. And overall, from a deal tenure win, the chatter on the street right now is that probably clients are a little cautious in terms of awarding longer tenure deals. The bets are still on shorter tenure deals. So is that a phenomenon that we're seeing right now in the market? This is mainly to get an industry perspective of what's happening.
So look, Q3 always you will get deals in Q3 that they have, you will get deals in Q3 that take a view on Q4, a view on entire year, because our Q4 and Q3, so our Q3 is a client's Q4 and our Q4 is their Q1, because most of them, these guys work on a calendar year and we work on a different financial year, right? So when I look at that, am I seeing a softness in terms of discussions? No, I do believe actually the chatter in the last 4 weeks has picked up. And December was slow because December is normally slow. People go on vacation, etc. So you can't get people in office in July. You can't get them in December. This is known and a fact, right? So where we are right now, we believe that we're seeing a fair amount of momentum with the 5 plus 10 million deals as well as the empanelment we've received. We're very happy actually and pleased this quarter on the wins that we've had, and we'll continue to work on others and keep coming back to you and announcing as they continue to happen.
Absolutely. And I think that's a great candid conversation, Amit, that I've had as well, and gives us a lot of perspective to viewers and investors as well. Thank you so much. Good luck for the coming quarters and speak to you soon again.
Absolutely. Thank you so much. And again, to your viewers and those that are watching, proud moment for the company to have achieved more than 1,000 patents. We are a technology company. We are not an IT company. Right?
Absolutely.
And
Absolutely.
profit margins being better. Thank you so much and God bless.
Thank you so much.